Robschild. No investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and of course a touch of crystal ball gazing. Today is Tuesday, March 18th, 2025. Today's episode begins with our headline, Fed meeting tomorrow, Wednesday. With all the chaos going on in markets lately, with the VIX spiking, S&P 500 briefly going into correction territory, down 10%, it's going to be an important meeting. And, the Fed has a chance here to discuss, whether they care or not, that the stock market's falling. The right answer, in my mind, is no, they shouldn't be. It's something they look at, but their primary concerns are inflation and employment. Of course, if the stock market continues to fall, we all know that unemployment pretty much tends to follow by going up. Any which way about it, tomorrow could be a pretty big meeting. It was only a week or two ago where we briefly had the Fed funds futures flip to a 50-50 for May, and now we're solidly 82.5% with no cut expected in May. Tomorrow's meeting may affect this. We may see it get pushed further out, the first cut, past June, or maybe we will see it earlier. I mean, heck, there's even a possibility, not really a possibility of a cut for March, unless something literally overnight happens that is just like huge black swan event out of left field. But right now, yeah, no cut for tomorrow. It's more about what the Fed says looking forward. Next item on today's agenda, I talked about yesterday, we might have sort of an upside down turnaround Tuesday, and it came. And here it is on the chart, the SPX, the S&P 500, yesterday's Monday green candle, followed by a turnaround Tuesday to the downside, 1%. I was kind of thinking maybe we would open higher and then close lower for the day, but instead we opened lower. I was looking to meet the 200-day moving average up here along with the 18-day moving average coming down to get to that zone before going back down, but it looks like we're jumping ahead to the downside for now, and this can be a predictor of further downside going through the rest of the week. Of course, we have to see what Powell's going to say and how the market's going to react tomorrow. There's a number of other interesting things going on in charts, but we'll get through all of this before we get to the rest of the charts. The third agenda item for today is sector signals. This isn't something I've brought up on the channel before, but it's another important piece of the puzzle, especially for macro data, and I think it supports my idea that I think a pretty big recession or even perhaps a depression is not on the horizon, right in front of us. So let's take a look at some charts here. There are many editions of this same chart. It just basically shows the business cycle and what sectors tend to perform better or worse throughout different parts of the business cycle. So in this column, early, this is after we had a recession. Early, we have the rebounds off of the recession. We have the plus signs and double plus signs are these sectors are performing well during this part of the cycle. You have financial, real estate, consumer discretionary, information technology, and industrials and materials all performing really well in the early part of the cycle. And then as we get into the late and into the recession part of the cycle, we get energy outperforming, utilities outperforming. Notably, when energy look at this, going from a double plus sign to a double negative when we're actually in the recession. And so take a special note of that one, the energy. And then consumer staples doing well relative to other sectors. So knowing this, if we go to finviz.com, they have a wonderful spot on their website that just goes through it's just finviz.com/groups.ashx, and it shows the daily, the weekly. I'm more interested in a little bit longer term to see what's more, averaging it out a little bit, 1 month and 3 month especially. And as you can see in the 1 month and the 3 month areas, the top performers right here, we see healthcare, energy, utilities, basic materials. Healthcare, energy, real estate, basic materials, and utilities. And then looking from a further time horizon, you can see the top performers over the past year, utilities, financials. So it's a bit of a mixed bag, you know, looking from further out. But the main one that I like to especially focus on is energy. And with the 3-month performance, energy and utilities outperforming most of the rest of the sectors, it just kind of tells me that we may be closer than ever to this recession, along with everything else that I've been pounding the drum about for a while here now. I think we're right between late cycle and recession, with energy outperforming and utilities seeming strong here. This is something to keep an eye on, a pretty close eye on, especially, you know, for me, when you look at the past 3-month and 6-month ones are the ones that I try to follow the most. Next today we have community topics, and someone brought up in a comment dark pool private rooms. Yeah, so I read the articles coming out about this. I don't have a whole lot to say about it other than, yeah, it seems like it's probably unfair considering, you know, if massive amounts of stocks are being traded at certain prices behind closed doors and the public doesn't have access to that. Yeah, it hurts mainly your retail day trader, basically, your guy in his basement trying to beat the markets with day trading and not really knowing, you know, what's behind the curtain. What are people doing behind the curtain? Yeah, it gives them a pretty huge disadvantage. And for that reason, it's like a little questionable as far as ethics go. And if there should be more regulation in that area, I don't know. Regarding investment, though, I don't think it, you know, when it comes to Benjamin Graham, when it comes to value investing, when it comes to determining what the value is in companies, it's irrelevant. It has nothing, you know, has almost no effect for what I consider to be serious investing. Serious investing doesn't care that much about daily swings in prices and rumors, and plus, you know, with these these private rooms and dark pool money moving around, like, well, who's right in the transaction, the seller or the buyer? You know, is the guy selling it like doing well, or is the guy buying it doing really well? It's like, non-issue for investors, but yeah, unfair for anybody that's trying to be a serious day trader, especially on their own. Coming up later this week, of course, tomorrow, like I said in the main title, tomorrow we have the FOMC meeting. The main thing really is what the Fed Chair Jerome Powell talks about. And then Friday is a big one for me, the leading index coming out at 10 a.m. This had paused for a little bit. I'm kind of wondering if we're going to be ticking back down. We had been collapsing in this for a while. We'll talk about that on Friday. Before we get onto the charts, thank you for watching. Please subscribe if you want to keep up with my content, and thank you for all the support. Your support has contributed a lot to the development of this show and my channel and everything about it, and I gotta say, thank you so much. Watch Macro Update 21125 to hear me explain my daily reminders that I think are very important. Not really any changes. The CAPE ratio, I think, went back up from 34 to 35 today, or I guess that was yesterday. I don't know, no changes really. And watch Portfolio Update 21125 to hear me explain my crystal ball ratings and my own personal portfolio. Moving on to the charts, the VIX, the fear gauge, the fear index of the pricing of options contracts, still notably above 20. This typically signals that we are still in fear mode, but the VIX term the VIX futures term structure is a lot less inverted than it had been before. It still is inverted. April's contract is still above the May and the June, so it's still like an alarm going off, but it's nowhere near as inverted as it was even just yesterday, suggesting that market participants in the VIX futures anyway are sort of not seeing as much volatility moving forward as we were seeing previously. So interesting little divergence there. I mean, maybe this is a little profit taking, or like, getting out of things and sitting on our hands and waiting to hear what, the Fed has to say tomorrow in the meeting. We'll see. Next, crude oil. I've been saying for a long time now, if we close and confirm and look bearish below 65, it looks like oil's going to be dropping by a lot. And it looks like that day may be coming very soon. Today's bearish red candle engulfing 1, 2, 3, 4, 5 previous candles. This is a very bearish looking candle, very bearish looking chart. I expect crude oil to continue down from here. Some traders have been waiting for it to sort of get up to around the $70 level before turning over. It looks like that may not happen anymore, especially if the Fed comes out and doesn't, say, hey, don't worry, we're going to lower rates, we're going to slam rates to the floor. If Mr. Market doesn't get what he wants from the Fed meeting tomorrow, oil might have a little bit of a hissy fit here. We'll see. Regarding longer duration yields on Treasury note and Treasury bonds, sometimes I like to look at the TLT chart, sometimes the 10-year Treasury note yield to see which chart looks cleaner. This one certainly looks pretty clean. I redrew some lines I had yesterday into, if you take the exact tops of these 3 wicks, they match up perfectly, and the 4 bottoms of these wicks matching up pretty perfectly, telling me that this is likely to break out. It's likely to break out to the downside. It looks like yields are itching to go lower. I've been saying this for I don't know, about a week now, and this is adding to that case. And if we break, for example, tomorrow down to out of this channel, it seems to me that they will break hard, and we're likely to go quite a bit lower in the 10-note Treasury yield. This would be beneficial to anyone invested like me, with 69% of my portfolio basically in basically TLT. I'm still fascinated by the S&P 500 looking so bearish, all while Dr. Copper with a PhD in economics continues to march higher, notably above the $5 a pound price today. I don't like trying to put too many narratives on it, but with, the good news recently coming out of China's economy apparently, and they use a lot of copper. Additionally, if yields are itching to go lower, and they do go lower, and therefore the Treasury can start spending more money again, copper will be used. It will be needed. Maybe that's why it's getting a bid. It's just it's fascinating to see so many parts of the stock markets falling apart here in the U.S. and copper, an industrial metal that's used for production of things, going up in price. I'm not sure what to think here. Gold, sometimes seen as a safe haven asset, sometimes seen as an inflation protection hedge. It is at all-time highs. It's continuing higher. Chartist I have a lot of respect for, Gareth Soloway, brought up interesting little chart here. If you connect the high of April of 2024, connect it to the high of October 2024, we're at that exact line. And if you drop it to a parallel, it seems like this may be acting as a channel. His line is better on his charts here. I'm not sure I have this right, but the point is that good traders see this as a potential short-term top in gold, but that's just a chart reading. Personally, I think gold overall is way overextended. I wouldn't touch it with a 40-foot pole until it's clearly cheap to me. It's not clearly cheap to me. Have it drop by 40 or 50% as it does pretty much every cycle. And then I will be interested. I'll load up on it. I'll get as much as, I'd say, 10% of my portfolio exposed to gold, probably through junior gold miners has the most beta. It has, it's the area that'll be the cheapest when gold has its down days. And, that's how I play this game. I don't chase momentum, but, for those of you that are chasing momentum and enjoying the ride of gold to the moon, good for you. I hope you sell it at the exact top. Next chart I wanted to bring up was junk bond credit spreads. I talked about very recently how it looked like we were just spiking in credit spreads spreading. So basically junk bonds, lower credit worthy bonds have to pay a higher yield relative to treasury yields. And we have been spiking up in this, and I said this was giving support to, the bear case. And suddenly, today, it looks like we're confirming a little bit to the downside here. I'm not sure I have no idea where it'll go from here, but we do have a bit of a sizable break in terms of, we're not going straight to the moon anymore, at least. So this takes away some of the power of the bears in stocks right now, especially. And again, this is on like a day-to-day basis. I'm talking about like the past 2 days, which is, not much. Overall, we have still been going up since February 18th. The next chart I wanted to bring up, you can Google this. It's the World City Surprise Index. It's a chart I have not brought up on my show before. The way it works is basically anything that's below the zero where my mouse is right now, if we get readings that are below zero, it means that economic data is surprising us to the downside. In other words, the market is expecting things to be better, but actually they're a little bit worse. And equally on the other side, when it's positive, when it's above zero, things are better than what the market was expecting. And the higher it is above zero, the better things are compared to what the market had been sort of expecting. I'm just going to say notably, we've had since November of 2024 sort of a lower high, lower low situation on a bigger view. The updates are unfortunately a bit, not a bit, quite a, how many weeks is that? 2-week lag? The most updated information here is Thursday, March 6th, 2025. So just something to keep an eye on, because we also recently crossed from being in positive territory towards zero, and now below zero here. The zero being where my mouse is currently pointing. Sorry, it's so small. Check out the chart yourself if you are interested. Last two charts I bring up mostly because, this is what I'm personally invested in. A large amount of my investment is in KWeb. Forming a little bit of a bull flag after breaking out of this diamond pattern I had talked about before. This is looking very bullish to me. It seems to me that we are very likely to get above the previous high from this, explosive growth ending October 7th, 2024. Again, I think this would be reasonable to get to a $50 range, and I'll be selling at a trailing stop loss out at that price. And also, Brazil, another huge portion of my portfolio, continuing higher today, looking, very bullish in light of what's been going on with the S&P 500 lately. As I mentioned yesterday, the past few days especially, I think, has to do with Basel III potentially changing, which means bank regulations changing, which means easier credit for emerging markets. So emerging markets are getting a little bit of a bid here, I think, off of that still. Again, I'm invested in these two emerging markets not because of potential like black swan events or this political thing might happen or that might happen. It's simply undervaluation. This fund alone, EWZ, has been at its bottom, was paying out I think around a 10% dividend, maybe even higher than that, which is like huge for an index of stocks. I mean, in 10 years, you get the full investment back, plus you still own the stock. So, which is a lot higher than the, 1.3% that our, S&P 500 here in America is offering investors. It's amazing. It's amazing how valuations can be so at odds. Incredible. But yeah, I'm a value investor. I buy stuff that seems overly cheap, and that's how I play the game. And that's all for today, and that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.